Over to you, Stephen. I don't think I'm going to take up any more time, but welcome, Stephen.
Excellent. Thank you very much for coming today. Delighted to be here and supporting Investor Summit as the first conference. So what I've got here today is to talk about maximizing outperformance with explosive growth opportunities. And I would explain what I mean by that in a second. I think as a starting point, if you are not familiar with us, I co-founded Blue Owl Capital 8 years ago with Peter Hargreaves, and we run a high conviction global strategy, long only equity, and currently we're running about £1.5 billion in the strategy. And the way that we go about this is we do all the research in-house and we invest into the best of 25 companies, which you can see some of that on the fact sheet. I think the only objective, which is probably the topic for today, is to run a strategy that will allow us to maximize our performance. And I think that message probably has been lost with some of my peers with the rise of passive ETFs, which have done a lot better than most active funds over the last few years. And the way that I want to probably explain this, how you can probably generate some alpha is through explosive growth opportunities. But before I kick off with a few examples on how we go about this, I think it's worth explaining what maximizing outperformance means. I think as a starting point, everyone will be very familiar with the power of compounding. I mean, that is a concept that's been around for a long time, and everyone should know that quite well. But what is equally important that hasn't been talked a lot about is the rate that you're compounding at is equally important. So if you're able to generate 10% a year for the next 10 years, I think that's very good compounding at 10%. But if you manage to do 14, 15%, then the size of your pot will be a lot bigger than if you just done 10. And obviously, there's a multiplier effect behind that. So then the question that we keep asking ourselves when we look at opportunity, which you can see some of them, the top 10 on our fact sheet, is that maximizing your compounded rate of return? So some of you may have seen that we have exited quite a few big tech names recently. And the question is not about some of these tech names might disappear. I think they would be with us for a long time, but the question is, are they able to deliver us the maximum return that we want them to deliver? So then there's always a question mark about optimizing the portfolio with better opportunities. Of course, from our perspective, we run a strategy with limited capital. So then we want to optimize the capital as much as we can. So that is what this means. The other thing which is equally important, just to probably recap, is the quality of the businesses are very important too, which is not what I'm here to talk to you about today. But quality means to us is about a good management team, strong balance sheet, robust business model, high return on invested capital. So all these are very important. But one thing that you have to remember, if you are active investors, that quality companies purely means survivorship. So these companies will survive despite the different level of uncertainties that we are going through. So they are transcending uncertainties. But the difference being is that they don't necessarily mean outperformance. So surviving any storms, which most companies would survive them, but it doesn't mean you can do a lot better than the market. So for me personally, quality businesses is a starting point. We want to invest into quality companies, but that only help me to sleep at night while I'm managing my investors' money, right? So that I know tomorrow, whatever happens, whether there's another Middle East conflict, COVID, interest rates, inflation, my company is going to survive, so they don't disappear tomorrow, right? If whatever the scenario that we might encounter in time. But it doesn't mean outperformance. I think that's a very important point to remember. So if you remember these two concepts, now I'm going to build on to the explosive growth opportunities. So there's a few elements to it, which I will come back on to shortly. The short definition of explosive growth to us are companies or sectors that can capture a lot of spending within the shorter space of time. So companies or sectors that can capture a lot of spending within the shorter space of time. And a lot of these companies that I'm going to talk to you about today, they are all quality businesses. So this is very different to some of others, maybe unprofitable growth strategy, investing into companies that hasn't got a robust business model and keep burning cash to gain market share. This is not like that, which we will run through in a second. But what is really important, which I will come back onto, is to be able to spot these opportunities. You need to take a forward-looking view rather than backward-looking. And a lot of people have asked us about this many times since we started. In the market, MSCI World Index has about 1,500 stocks, and we only invest into just about 25 stocks. I would say that we have done probably work on over a few hundred companies since we started the journey 8 years ago. And on an ongoing basis, we cover about 100 companies. So roughly that, right? And then people would say, okay, do you use any quantitative screening? How do you narrow down the companies from 1,500 to the 25 that we have got in the fund? And the short answer to that question is we do not have an in-house process for quantitative screening because I never believe in it. The reason I don't believe in it, not that there's no value to it, but not enough value, is all backward looking. So if you think about quantitative screening using historical financial of any companies, whether the margin profile, return on invested capital profile, free cash flow margin, a lot of things, is all backward looking. But to be able to do a lot better than your peers, you need to take a forward-looking view. And I want to quickly just introduce a concept that we are all contrarian here. So even though that when you look at some of the companies, we still have a very large holding in NVIDIA, but we have been a contrarian investor in NVIDIA when it firstly surpassed $1 trillion in market cap. And obviously now it's over $4 trillion. And a lot of people still don't believe in NVIDIA, which is okay. So it's all about taking a differentiated view on a company. And then you need to be forward-looking to do that. So the few examples I will share with you today, and hopefully that will be instructive, that we can all then start to look out for explosive growth opportunities. The first one would resonate a lot with us, would be during the pandemic. When we first started the journey 8 years ago, back in 2017, we were heavily exposed to digital transformation opportunities. So that encompass e-commerce, digital payments, digital advertising, software, cloud, and that was before Amazon are now charging us $20 a month to pay for the subscription, right? That was a good old days. They were still selling us the software on a CD, which would cost a few $100s, and then you install it, but then you're not in a rush to upgrade it if you don't have the money or you are not a fan of the latest version. So that was the very old business model. Of course, then when you look at a lot of the characteristics of these companies, the e-commerce company like Amazon, the digital advertising like Alphabet and Meta, the digital payment company like PayPal, software companies like Salesforce, Microsoft, or Cloud, Marriott Cloud, they were all very high-quality businesses before the pandemic. So that's a very important point to remember. They were not those names that ended up spending a lot of money like, I don't know, like Zoom or some other names that basically very low quality, hasn't got an established business model, but managed to spend a lot of money to capture market share. These companies are not like that, right? These are in a very different camp. They're already highly profitable, have good market share. But what happened during the pandemic, as we all know by now, is they went through a 2-year period of explosive growth journey. So what happened at the time is anyone who hasn't got an Amazon account or PayPal account would probably got one by the end of the pandemic. Anyone who hasn't worked from home before would have worked from home. And if you ended up working from home at the time in the white collar domain, you would have got a Microsoft Office 365 account. Your company would have got you one, otherwise you wouldn't be able to do your job. So then what happened during that 2-year period was they went through an explosive growth period. And if I give you one number to remember, was when we first started the journey back in 2017, digital advertising as a proportion of advertising budget was only a third. The other 2/3 was in traditional media, which is TV, print, and billboards or newspapers, magazines. By the time we got to 2021, that split got flipped. So 2/3 of the current spending in advertising is in digital media. So then by the time, this is the question, by the time you get to, let's say, 70% market share, from 30 to 70, it's a lot more difficult to grow, to be exposed to the explosive growth journey, right? Like you can grow from 70 to 80 or even to 100 in some cases, but that most of the time it would not happen just because there's still a generation who might prefer a certain medium to consume the news or entertainment. But then it's a lot more difficult. So where do you make the most money would be that 2-year period, right? So that is what I want to outline today. The next couple of examples are live examples that we have done in the fund over the last 18 months or so, and they are still in the fund. So this is what I'm going to share with you today. So what happened since the pandemic? What are the next explosive growth opportunities? The first one everyone will be familiar with is European defense, which is a very unusual sector for us to consider. If you actually follow our strategy, our peers, I mean, we consider ourselves as quality growth investors. And I would say European defense as a sector has been around for, 50 years. It's never been in the camp of quality growth investing. I would say probably quality deep value. The reason is quality deep value is because there's no growth opportunities. European defense budget has been growing in line with European GDP for the last 20 years. And that number would be in the range of mid-single digit, right? So a few percent growth per year. And of course, I mean, as we know, we now know that European Union has been underspending their target as well. So hence what Trump is trying to change, how Trump is going to change that now. But then when you look at European defense before the Ukraine crisis or before Trump was elected, let's say if you were using some sort of quantitative screening, you're looking at historically, like what has this sector done? Is that an interesting sector? You would have missed the opportunity. That journey started with Ukraine, obviously, but the real driver was on the back of Trump being elected late last year. Everyone knows that, right? Like he has been talking about this for a long time. So we started our journey about 18 months ago, and we ended up doing quite well on the back of this. And of course, what happened this year, early this year, was the conversation between Trump and Zelensky in January or February. That basically Trump said to Zelensky that I don't really care about Russia. They're not our enemy. I'm not going to support Europe. You're going to sort yourself out. Of course, what has happened since then now is old news, that European Union or politicians have made European defense as the highest priority on their agenda. And they are going through an explosive growth phase. So when you look at some of the companies that we have in the fund, let's say Leonardo, I mean, it's gone up like 80% this year in share price terms. That's a lot for a very traditional average growth European defense company over the last 20 years, but it's gone up 80% this year. So I think that is something that, as an investor, that's what you want to keep looking out for. The second example, which is also live, which you might be more familiar with, is US sports gaming. So we have got this company called Flutter in the fund, used to be London listed, now is redomiciled to the US. And if you think about US sports gaming, it has never existed until 5 years ago. So we are all familiar with sports gaming in Europe, in UK, in Asia, but it was never a thing in the US, even though the sports market in the US is the biggest in the world, as you can see on how much money being spent on Super Bowl, the NFL, and NBAs, and some other stuff. And secondly, what we know is American consumers are the wealthiest cohorts by numbers, right? So they love their sports, they have money. What do you think is going to happen when the US started to legalize sports gaming 5 years ago? So currently, about 50% of the population or by states have got access to sports gaming. The legalization journey continues. Okay, what it means though is when you look at the gross gaming revenue, basically all the money being wagered on sports in the US today, it's gone up from 0 5 years ago to $100 billion today. And that journey continues. And then the question is, like, where does the money come from? It has to come from somewhere, right? We would think, and we've speculated that it's probably going to come from people, American consumers spending less money in maybe buying a fewer stuff from Amazon, or maybe cutting back on some of the entertainment, going to cinemas, or maybe some holidays. But that number is $100 billion. And it's a two-players market, so it comes back to quality. So this is the quality investing. It's a two-players market between Flutter sub-brand called FanDuel alongside DraftKings, which is a separately listed company in the US. These two companies control 80% of the market share. So that is very interesting to us. But then if you were to take a look at the historical financial of Flutter, let's say before 2022 or something, you would have missed the opportunity. So you need to keep asking yourself, what is new? What is going to be game-changing? And at the same time, building onto the companies that are already quite established. Like Flutter has been a highly profitable company in the sector, right? But then suddenly got exposed to one of the most exciting opportunity in the US, which is the biggest market in the world. So that is very interesting. The other one, which everyone will be very familiar with now, is artificial intelligence. If I just use a few numbers to illustrate the point, which I have spoken about this before, but it all resonate with other opportunities I just talked about earlier. It's back in 2022, NVIDIA as a company, which most people haven't heard of, but now we're all very familiar with it, has been around for over 20 years. So NVIDIA is not a new company, it's not a fancy company just started from nowhere. It's been around for 20 years. Run by the same guy, Jensen Huang, who has now become a celebrity. But before then, he was not as well known as he is now. And NVIDIA was making $30 billion in revenue by 2022. And then if you look at the historical financial, which I can understand why some of my peers might have decided not to own it, was that you look at the journey of NVIDIA for the last 20 years, they were exposed to PC gaming. The GPUs that they sell would be used in the Activision's Call of Duty and all these very sophisticated games. Later on, they got into crypto mining. So a lot of crypto miners are actually using NVIDIA GPU to mine Bitcoins because it's very powerful, very task-specific. And then later on, they got involved with the real-time recommendation system with like YouTube, Netflix, and Amazon. So if you're trying to if you're watching a video on YouTube, you then get recommended some other videos that you might be interested in, or TikTok as well. They were involved in that. But it was nothing as exciting as what had happened in the last few years, right? Which is generative AI since the introduction of ChatGPT back in Q4 2022. But that number, so NVIDIA has been a company around for years. Everyone could have been comfortable owning it at the time. But what happened in the last few years, as everyone would know by now, is the revenue that NVIDIA is making this year is about $200 billion. So 3 years ago, in 2022, it was making $30 billion, very high margin, profitable. and now it's making $200 billion. And the free cash flow number they're going to deliver, which is over $100 billion, is the number one and number two, the highest number in the world, alongside Apple. And it's a lot higher. $100 billion of free cash flow is a lot higher than any other companies like Microsoft. So that is explosive growth. Of course, what we are not saying is NVIDIA or some of the names that we mentioned would repeat the journey they've seen, right? I'm not expecting like NVIDIA is going to make, I don't know, $500 billion in 2 years' time. It's not possible. I think there's some physical constraint, there's some penetration challenges that you need to tackle. But that would be the time to own it. So to summarize, to be able to maximize our performance, to do something different than your peers, you need to take a forward-looking view. At the same time, if you can get comfort about the quality of your businesses, let's say they're quite high quality, they're not going to disappear for whatever reason, they're not burning cash just to gain some market share, which there are many of them in the world to do that. And then you manage to spot them before that journey starts. That is when you're going to make a lot of money. And just to finish my presentation here is, of course, the biggest competitor that we have been facing over the last few years or going forward is the passive, the rise of passive ETF, which we deem as the only competitor now in our world because it's outperformed majority of our peers over the last few years. But this is something that passive cannot do. Because if you really think about passive trackers, let's say S&P 500 index or MSCI World Index, is a reflection of the historical success of companies that's got that, right? So Apple is still one of the largest companies in the world, even though it's come down a bit, it's still $3 trillion. And everyone who's buying passive is building onto the view that Apple would remain successful. But of course, I mean, that is not our view. And I think there's some real value to be added by active investors if you can be forward-looking. And then the question you keep asking yourself is this opportunity going to maximize my outperformance? Is that now? Is that 3 years later? If you tell me it's 3 years later, then take a look 3 years later or 2.5 years later, right? You don't invest now. So you need to keep optimizing your portfolio. So I will stop here and happy to take questions.
Hi, Stephen. Firstly, completely agree with you in terms of being forward-looking. Lots of people might say, though, how do you define your edge? I completely agree with the outline that you follow. I do very similar. But let's say, for example, someone were to ask you, okay, how do you objectively define your edge? What would your reply be?
It's a very good question, by the way. I think it's something that I've been reflecting since I started my investment career over 25 years ago. It's a difficult one because obviously the market is very efficient. The market continues to be increasingly more efficient as the day goes on, like with more information being disseminated on a real-time basis, everyone have access to the same level of information. And I would say today, or at least for the last 8 years, where my edge comes in, or the Blue Owl edge comes in, is the real focus. It's the deep dive research, it's the real deep dive research, not just some level research. Because I remember my time, that was back in the good old days, probably 20 years ago, that there was still a time, at that time, there was still quite a bit of value when you go through the broker's research or when you speak to the sell-side analyst. Because there are certain things that the sell-side analysts manage to capture that you might not have access to, right? But of course, the regulation have changed all that. And nowadays, I would say there's probably little value in terms of brokers' research. And of course, I think how it has evolved over time is now most people, I would say most investors, are not actually want to spend time going very deep into the company nitty-gritty. A lot of investors are probably taking a top-down view. If you like AI, you probably buy AI basket of stocks. You're not going to do the work on different companies unless you're really passionate about that sector on its own. So I think when you are connected really well, and if we think about what we have, is there are 5 of us on the investment team covering about 25 stocks. You're talking about, on average, we cover 5 stocks per head on a full-time basis. That is a lot. So I don't know how many stocks you have, and I'm sure you have a day job too, right? So then the level of focus that I would say that we probably out-compete or out-research than most of my peers who hasn't been as focused. But at the same time, I think once you're really well connected, is something that I probably have talked about in the past, is when you do the work on NVIDIA or any of the company I just mentioned, you don't just do the work on a company, right? You have to do the work on the entire sector. You have to do the work on the big tech companies who are spending all their free cash flow buying NVIDIA GPUs or Broadcom's in-house GPUs. Where's the money coming from? And then you have to look at TSMC, whether they're going to increase the kind of the outlook in terms of the customers' demand. And everything is interconnected. But only when you have the time that you can basically map out this ecosystem. And so if something have changed, even though that was before the company has reported or maybe signaled certain things, you might be able to take a quicker decision. So I think the short answer is, I never quite worked out whether we have an edge in terms of what we do, but I think in terms of time and focus, I think that's quite a lot of value behind that.
Stephen, much appreciated. Next question for the young man at the back. Go for that, so thank you.
Hi, Stephen. Thank you for your talk. I was just wondering about explosive growth for late-stage companies. So, for example, SpaceX or OpenAI. How do you think things like Blue Whale or public retail investors can get access to that? And what's your view about the future? Is this going to continue to be a trend where late-stage companies that would be listed stocks are going to stay private for a longer time? What's your take on that, please?
Yeah, I think the short answer to the first question, whether we'll be interested in SpaceX or OpenAI, I'll probably say no. I think the quality is not there. They're not well established. I mean, it doesn't actually fit. I mean, like OpenAI is not profitable from my understanding, right? It's a very competitive world out there. Obviously, they have raised money. They got into partnership with Microsoft. Is that actually a sustainable business model? Are they going to be the ultimate winner? I think the likelihood of them winning part of the race, I think that is fine. That's a tick in the box. But are they going to be the only winner? What happened with Google Gemini, Grok by Elon Musk, the Meta AI, Perplexity, there are many others, right? There's DeepSeek in China as well. So I think as far as a business model is concerned, we would not consider OpenAI as a quality company today. But of course, at some point, they might become a very well-entrenched company. And you have to remember that in one of the examples I've shared before is Google Search is very dominant, right? It has 90% market share in search world. The other 10% will be shared with Bing or some other smaller players. But Google Search was the 7th search engine being created, a lot later than many others that now have disappeared. So being a first mover doesn't guarantee you to be a success, right? Like, so to us, OpenAI is like you need to spend a lot of money to join the race, to join a marathon. But whether you would become an ultimate winner, that's not clear yet. So I think that would be a pass for us. I think the second question is, I think it's been true for some time, just because the market is very challenging in a way that it's very difficult to raise money. So I think you do see more companies, which is not a new trend. That trend probably started 5-10 years ago, to remain private. So which means that by the time they come to the market, we are not going to get a lot of value in a secondary market when they IPO. So compared to before, like if they couldn't get to a certain size and then they come to an IPO, raise money from investors like us, then you get better valuation, right? But by the time they become so big and they got loads of cash, the valuation that you get is going to be probably more overvalued than undervalued. So hence, like, I think the return profile from most IPOs are probably not great, but that would be a function of them staying private for longer.
More question. Roger Green, thank you for joining us.
Thank you very much, Stephen. Interesting presentation as ever. I'm a holder of the fund, so I'll qualify it in those terms. Do you see a natural tension in the style that as the fund gets bigger, you concentrate your portfolio, so big positions, so you're looking for large companies that are going to grow explosively, and they have to be quality companies, so you can cross off the SpaceXs and so on. Does it not get to a position where as the fund gets bigger, it gets harder to find big enough, high quality, and then trying to layer, sort of galloping for an elephant on top of that?
Yeah, I think that's a question that is quite valid, that we do reflect on that from time to time. I think what's been interesting is when we started the journey back in 2017, we were running 25 million pounds. Okay, now we're running 1.5 billion pounds. But of course, when you look at the size of the market, at the time we didn't have any $1 trillion company, right? Every company that we're talking about today would be in the range of $500 billion. And when you look at the size of the market now, it's a lot bigger relative to the size of money that we are managing today. So I think ultimately it's always a function of the opportunity set. And I think the question comes is like when is too big? When do you get to a point that it becomes too big that you cannot maneuver or you cannot find opportunity that can make you alpha? I think that would be a question that we would have to reflect when we get to that journey. But I would say that in today's context, I would think like if we are multiple times bigger, let's say a couple $1 billion, we are still very small in the ocean of opportunities. But of course, if we become, 10, 20 times bigger, then maybe it's a question that we need to answer at the time.
Okay. I think Stephen Yiu deserves a round of applause, ladies and gentlemen. Thank you ever so much.
Thank you.
Stephen Yiu, co-founder, chief investment officer of Blue Whale Capital. We're also the platinum sponsor of this event. It couldn't have happened without Stephen and Blue Whale supporting us. So thank you, Stephen. Thank you very much, sir.
Thank you.